curve flattening on both sides of the Atlantic, but more markedly in the United States, suggests investors have doubts over the future path of inflation and may be starting to price in a downturn just as the global economy picks up speed. Since the Fed began raising rates in 2015, the difference between long and short-term U.S. yields has shrunk to levels not seen since before the 2008 financial crisis, reaching 67 basis points, its flattest in a decade, in the past week. That partly reflects uncertainty about the passage of a Republican-sponsored bill to cut U.S. taxes, which has hauled down longer-term projections of inflation, while expectations for upcoming rate increases push short-term yields higher. With curve flattening typically signaling a muted outlook for both growth and inflation, the trend suggests investors see risk that the Fed's current monetary tightening cycle will start to slow the world's biggest economy. A flatter curve, which makes lending less profitable, also poses a risk to the banking sector, nursed back to fragile health by central banks after it nearly collapsed a decade ago. But with crisis-era policies still largely in place, how would central banks cushion the impact of a downturn?